Welcome back, traders and investors. We have Larry Doyle on the line. He is the author of Sense and Sense. Larry's been a long-time associate, founded DM Income Advisors, an investment advisory firm focused on generating meaningful level of tax-exempt income. DM Income Advisors has a strategic relationship with an asset management firm uniquely positioned and qualified in this industry of the high-yield tax-exempt investments. He began his career in 1983 as a mortgage-backed security trader at First Boston. Larry, how you doing today?
Doing fine. Thanks very much for having me on.
Okay, now this is kind of a general question. Now I know it's kind of hard to answer, but what percentage of a person's portfolio do you think they should have in tax-exempt income?
Well, again, obviously, it is tough to generalize depending on where one is in the context of their career. But within across a diversified portfolio, generating tax exempt income, I could envision anybody having anywhere from say 10 to perhaps upwards of 40, if not 50% of their overall exposure. But again, if there were a general number, I would say 20-25%.
Yeah, of course. If you're retiring, you've taken
Exactly.
the risk earlier in your portfolio. So where are the best arenas for tax exempt income right now?
Well, what's interesting, really, if you just take a step back, I mean, the municipal market overall has gone from what was largely a commoditized market, in which most deals had some sort of insurance or a wrap placed around it, and just slap a AAA on and just pump them into the mutual funds. That game to a large extent has changed. And why is that? Well, because the underlying credits, there is wide disparity within those underlying credits. So you go from Puerto Rico to Detroit to to other entities, municipal entities, whether they're cities, states, or towns, that are doing just fine. In my opinion, the market doesn't fully differentiate enough at these gradations. So where do we look? We look for individual situations within the education sector, whether those are charter schools or university housing, senior care facilities, some airport and transportation, but really to drill down, I mean, there's significant level of due diligence to say, okay, what are the real dynamics and the financials behind these transactions? Because if you drill down and you get into it, there's some what I view as real value, because some of these bonds are priced, north of 6%.
And where's the risk? Where's the risk for people that
Well,
are?
it's again, some of these are smaller deal size, so it's a bit of a give liquidity, pick up yield, pick up income type of transaction. And where are the risks? The risks are with any bond, the credit risk. But to do this, you can't just, not every charter school, not every university housing deal is the same. Many individuals, don't have the aptitude or the ability to get into the nitty gritty. But I would also say that many mutual funds don't do it as either. The mutual funds, are in the volume business. So they just, they wave things in and then they wave things out and deals get buried. To understand the risks of the credit risk of the borrowers, that's where, individual investment advisors can bring, a degree of expertise, and that's exactly what we do. We follow every dollar.
Did you get caught up holding any Detroit bonds, Detroit City bonds?
No. The businesses that we're involved in, the partnership that I have, we do not play in the general obligation space for the very simple reason that, the risk-return profile, why bother?
Okay, and what about the situation in Puerto Rico?
Also, past no interest. We've got no interest in getting involved in, okay, black holes or situations where, okay, it's going to take significant degree of time and effort to either work out. What we're looking for are good, solid deals, clip coupon, and that's not to say that there aren't trading opportunities for people that say, hey, okay, bonds get overdone, so we can buy them and then we'll flip them out next week. Yeah, you know what? Not a lot of interest in that. What we're trying to do is find good credits, do our homework, do our due diligence. This is the slow and steady, wins the race. We'll meet you at the finish line.
And what about we had a guest on earlier. I cannot remember who it was, but he was very worried about what was going on with some of the Argentinian bonds. Have you been following that
Well,
situation?
I just kind of from. I mean, it's certainly been a fascinating situation, and I give a ton of credit to what's the fellow's name, Singer at Elliott, who, I mean, talk about staying power. I mean, he's been fighting this fight for, 10, 11, 12 years, something like that now. Talk about, having wherewithal and stamina. So it's certainly a very interesting situation. And what it gets to is the rule of law. And, what a novel concept, right? To actually uphold the rule of law. I mean, the rule of law in our nation, regrettably, has gotten obliterated all too often. And what happens as a result? When the rule of law is not upheld, capital will certainly slow down, if not cease to flow into certain sectors. I mean, this is why you have contracts. But, unfortunately, with Uncle Sam, in ever larger presence in so many different sectors of the markets and in the financial system, the rule of law in these contracts, Uncle Sam is not exactly the best business partner. And so I think right now, Argentina being what it is, I think, our government would like to see the, certain bondholders kind of, roll over. But, credit to the courts and say, hey, wait a second. What's the contract? Let's actually look at the contract here, and how does this work?
Okay, Larry, we're talking about interest, talking about tax exempt income. You got to be talking about interest rates. If you're talking
Yep.
about interest rates, you got to be talking about the Fed. The Fed has a meeting today. They're going to, accelerate the pace of the taper. I mean, could you just give us your short-term outlook and your long-term outlook for interest
Well, in my
rates?
opinion, whether it's the taper or keeping Fed funds rate at zero or any of the other the twists that they have, all these different machinations that the Fed has utilized in an attempt to try to keep the economy, somewhat propped up. But what are we seeing? Coming into the year, this was the year we were going to get, north of 3% growth, right? Well, here we are in July. We had a negative 2.9 first quarter, and people say, oh, that was an outlier. We're going to get a rebound. And what do we see? We see, outlook for growth getting marked down. Now we're talking, well, maybe it's going to be, two, hopefully it can be 2.5, right? Well, you know what? I mean, we've averaged a 2% growth rate for over the last 10 years. And in my opinion, we have borrowed from the future. So I think that our economy is like a walking pneumonia economy. We're not going to die, but you know what? This doesn't feel very good. And so when people talk about, okay, the Fed's going to start to increase rates first quarter, second quarter, third quarter, my response would be, how the hell do they know? I mean, they don't know what's going to, I think that so many of our economic measures, whether it's inflation, whether it's GDP, whether it's unemployment, I mean, these figures, facts and figures, are massaged to the point of being manipulated to give the appearance of a stronger economy. I just don't see it. So as a result, I think interest rates are going to continue to stay low, simply because the underlying economy is not as strong as that they would like to try to project.
Okay, so based on that, you must not be enamored with the job that Janet Yellen's doing, or do you think she's just in a real pickle here and there's really not
Yeah,
much?
I mean, come on. I mean, again, first and foremost, We no longer have an independent Fed, and that was not Janet Yellen's doing. I mean, the Fed hasn't been independent in a long time. So I think they're concerned with asset bubbles, primarily in the equity market. So they want to talk about, okay, well, we're going to have to increase rates here at some point to see that we don't get a further bubbling in the equity markets. But honestly, I would take the over, or a longer time horizon when they start to actually increase rates as opposed to sooner, simply because our underlying economy just isn't all that robust.
Okay, so commenting on the tax-exempt income arena and just the general market here up at these elevated levels, could you just give us, our traders and investors, just your advice for the market at these current levels?
At these current levels, well, we have not had a significant pullback of 10% in, I think it's been about 2.5 years. So we're certainly overdue for some sort of pullback. Find credits, find specific situations that you're comfortable with. Buying the market at these levels in the hope or anticipation for further. I wouldn't be advising that. So, as a result, what are we seeing? Merger situations, acquisitions, mergers and acquisitions, instead of, organically growing businesses. Businesses are now just buying others. So, strategic situations in which you're getting good advice, and I always recommend dealing with a fiduciary, people who are actually going to, look out for your interests as opposed to just simply trying to sell you something that's deemed suitable.
Okay, Larry Doyle, author of Sense on Sense, making some sense out of these markets, especially the tax-exempt income. Larry, thanks for coming on. We'd love to get a fundamental take on things and talk, something besides the technicals. I'm sure it's helping out our traders and investors. Thanks for coming on, and
well, you guys do a great job. Thanks very much for having me.
Okay, thank you, Larry.
Bye-bye.